Welcome to the Rich Report. I'm Brent Richardson. Thanks very much for joining me. So, over the past week, bond yields slid. Now, bond yields affect fixed mortgage rates. They determine or price fixed mortgage rates and if they'll go up or down. So, bond yields dropped. Therefore, fixed mortgage rates, there's some negative pressure on fixed mortgage rates right now. We could see fixed mortgage rates drop between zero point 0.5 and zero point 0.1. Doesn't sound like a ton, but across a country as big as Canada, that can do a lot of benefit for mortgage holders. Um, and the other thing is that the likelihood or the odds of a Bank of Canada rate cut on October 29th has shot up to 80%. So we don't have any certainties. We only have probabilities. And the probability right now is for 80% chance of a cut. So not quite a shoe-in for this upcoming meeting. This could change next week. On Tuesday, there's going to be a CPI inflation release, which could change these odds, but likely it'll stay pretty high. I think inflation's not going through the roof right now, although it definitely feels like when I go to the grocery store, gas prices are at least dropping, and there are some weaknesses certainly that are not necessarily inflationary. So let's keep an eye out for that inflation report next week. But from a rate perspective, it is looking better and better. We're not quite at 50 basis points or 0.5% for Central Bank of Canada total cuts before they pause. We're still at 0.25%. One more cut is still priced in, but slowly but surely we're inching towards that 0.5% cut. So stay tuned and see how this plays out over the coming weeks. See if we get to that 0.5% cut. So what did all this? What has caused the odds of a central bank cut in October to shoot up to 80%, and for negative fixed rate pressure with lower bond yields? So both the Tiff Macklem at the Bank of Canada and Jerome Powell at the Federal Reserve in the US, they've had different meetings, respective meetings this week. Both were very, very dovish, meaning that they were very open about their willingness to cut rates due to economic weakness. And so, what's bad for the economy is good for rates, kind of a double end there. But in any case, they both acknowledged the weakness in employment. And in Canada, GDP growth is falling below economic potential to approximately 1% growth. It's still growth, but it's not what Canada's used to for a nominal GDP growth. It's certainly beyond or below, beneath the potential of the Canadian economy. So this was a major effect in pushing down bond yields. Basically, they're saying we're going to lower. So bond traders, the market analysts, even the ones that were bearish that said, inflation is going to take over in the short term and they're not going to cut. Well, inflation still is high in Canada. It's hypothetically too high as of today, but nevertheless, they can see the deterioration and inflation's likely to drop. They want to try to get ahead of any bigger drops economically, which will pull inflation down maybe too much by dragging down the whole economy. They want to stimulate the economy a little bit in advance to try to soften that drop is where they're coming from. So we'll see. We'll see over the next few weeks. Stay tuned, or even days. October 29th is coming quickly. A couple other things that are really affecting the economy and mortgage rates. One is the price of oil. That's at 2021 lows right now. So it's been about 4 years, even a bit more, since we've seen oil prices near $60 a barrel. So this has the ultimate effect of lowering Canadian bond yields, because with less revenue coming in to Alberta and federal government coffers, this means that more stimulus is needed by the Bank of Canada. So lower rates. When there's lower rates projected from the Bank of Canada, that's primarily what causes bond yields to come down, and in turn lower fixed mortgage rate pressure. So watching that oil bond yields coming down, and also our currency is coming down a lot as a result of lower oil prices. Maybe they'll rebound later in 2026, but probably not in the next few months or even a year. There's no real sign of a rebound there. Um, Finally, there's been a banking scare in the US, a regional banking scare in the US. And this banking scare, this had a major effect on US yields. And there are all sorts of terms being floated, such as where you see one cockroach, there are many. There's this thought that maybe several of these regional banks in the US will have major loan issues and there might be a collapse. There's a lot of fear. And so this really dragged down the US yield. And it dragged down the US bond yield enough to also pull Canada's bond yield down. So this regional banking crisis, it could blow over, and maybe there is a bit of upward pressure on yields, or it could get a lot worse. And this would probably pull Canada's yields and Canada's fixed rates down a lot with it. One more thing, I couldn't forget this. The Stellantis issue, the recent loss of 3,000 jobs in Canada, in Brampton, Ontario, um, is not enough on its own. It's a tragic loss, I think, obviously for those families and for the local economy. But on a national level, that one issue is not enough to affect the total economy. If we see a continuation of this, though, if it spreads, if we see shutdown after shutdown, that'll certainly have an effect. So this is playing in as well. Everything we talk about here is really distilled or baked into these bond yields. It's baked into Central Bank of Canada probabilities. So when we talk about that, we're talking about everything. If you like this line of thinking and how these economic factors affect the bottom lines of many, if not all, Canadians, from your dollar to the interest rates you pay on a mortgage or even a different loan. Stick with me, stick with this channel, like and subscribe today. Thank you so much for watching. I wish you a good day.